Welcome, everyone, to Supply Chain Resilience, Navigating Turbulent Waters. I'm your moderator, your host, Matt Leffler, armchair attorney, podcast guy, lawyer, and a supply chain advocate for the better part of 15 years. Look, what we're seeing in the market is something that is not new, kind of new, feast or famine. That's how I've always heard it been told. But, for this, I want to get in some experts. And my hope today was to bring in some of the best leaders in supply chain to help break down what is going on, look at the data, look at the trends. Where are we going to be? How are we going to get there? I cannot thank you enough for making the time to tune in and to reserve a spot here. Obviously, we are excited to break this down. We have Jason Miller, who will be joining us in a moment, Dave Broering, and Ben Gordon. They'll all be here in a few minutes. But before I welcome the guests, what I want to do is thank you again for taking the chance to tune in. If you're watching this live, great. We can take your questions in real time. If you're listening to this on the podcast, thanks for tuning in. As always, I got to thank my folks, my friends over at DAT, Dial a Truck Dat. They have been helping truckers find loads since 1978. That's a good thing. We want truckers to be profitable and productive, and that's why they keep doing what they do. The world doesn't move but for trucks. Everything that comes to your home or to your doorstep or to your grocery stores are touching the supply chain in some way. And over the last few years, we've seen some enormous changes in the business. And to help break those down, I have assembled a team of experts, truly experts in their fields. Jason Miller, all of you know him. You've seen him on the interwebs, professor at Michigan State University, Eli Broad College of Business, interim chairperson of the School of Supply Chain Management. Jason is one of my favorite people in the space, and I am so excited to welcome Jason to the program. Jason Miller, how are you?
I'm doing well, Matt. How you doing, man?
I am living La Vida Loca. That is the only way that I have been told to live my life, and it's going well so far. My twins are nearly 18 months old now. It's a couple days away. It goes fast, doesn't it?
Oh, I know. I've got an 8-year-old and a 2-year-old. So yeah, it's hard to believe. It's like I blinked and the 8-year-old's now like 5 foot tall.
I look at my 11-year-old and go, you were that big as an 18-month-old yesterday. Like, luckily, I am still the same age, I think, that I was 20 years ago. I am excited to have you on, and I'm going to welcome the next panelist we have. Dave Broering is the president of NFI's brokerage division. He's been a broker in transportation and one of the best operators of the business. Dave, thank you so much for making time to join us today.
Hey, Matt. How you doing?
I am so glad to have you here. Thank you for making time. We had our conversation a couple weeks ago, and it's great to have you back. And just joining us now from Cambridge Capital, this is my good friend, Ben Gordon. Ben, how are you?
Matt, great to see you. How you doing?
I'm so excited, guys. So this is kind of a collection of some of the best minds in transportation, the expertise of academics, operators, and investors. I want to kick this off to you, Jason, to start off with. What is going on? Why is things the way that they are? Tell me about where we've been and where we're going.
So really, basic answer is we still have way too much capacity and not enough demand. First quarter of 2021, the one trucking ton mile index I produce, the data for March we just got, and March was really soft. And February was soft. January was very, very soft because of the polar vortex. And so freight demand was down about, over 1% year over year on a seasonally adjusted basis. March this year was odd because it's Easter showing up in March, which is kind of not normal. So if you take that out, it was down about 2.8% year over year, which is a fairly steep drop. Right now, freight's down, demand in total is down at least 4% from the peak level we saw in early 2022, 4 to 5%. Probably in the long run, I'm guessing that number is going to be closer to 5 to 6%, given some other Census Bureau data that's just been released. And so this is right now double the depth of the freight recession we saw in 2019 from the peak in late 2018. So we are in doubly deep of a freight recession. We still haven't seen as much capacity exit as we would expect. Seasonally adjusted employment in trucking has actually been trending upwards since the failure of Yellow between July and August of 2023. And so there's still a fairly large gap between that demand piece and the supply piece. And that's what's keeping rates low. And I think the one thing that's causing a lot of cognitive dissonance is the fact that folks are looking out saying, but I'm reading all of these reports of containerized imports being up, double digits year over year, but the freight market's actually reflected in all the public and in general, on average, in the public TL and LTL carriers' financials.
So as you kind of outlined that, we saw this amazing demand throughout the COVID period. And then we've seen this kind of slowing down, this kind of freight recession. It seems to be protracted. You give some great numbers here, but I'm curious, Dave, like you're in the weeds every day. You have teammates that are out there calling on shippers, calling on motor carriers. What are you seeing in the space right now?
It feels as bad as Jason says it is. I mean, there's really no two ways to slice it. Look, this industry has gotten comfortable with feast or famine. And I mean the intermediaries industry, right? So like us as freight brokers standing in between shippers and carriers and connecting capacity with demand. And the market moves. I think the weird part about this market and some of the cognitive dissonance that Jason's talking about, setting aside the mustache that I'm still struggling to get past here. I just couldn't pass it up, Jason. I'm sorry. Is the fact that typically transportation sector is a leading indicator for the economy and is a predictor of economic struggle. And that's just not been the case the last 18 months. And it's not that the economy is rip-roaring hot, but it's also not struggling tremendously either. It's just that the sectors that really drive the ton mileage in this country are the ones that are struggling the most economically. And Jason, it's one of my favorite stats that you taught me years ago is the ton miles driven in this country. It comes from manufacturing. It doesn't come from as much from retail. And so retail has been relatively strong. Travel has been relatively strong, but durable goods, manufacturing, home building, they've all really struggled. And as a result, it's left this gap between supply and demand that nobody is closing relatively quickly. And I think it's confused a bunch of us on the carrier bankruptcy side. We haven't seen nearly as many exits that you might have expected. And maybe that's carriers doing a good job of holding on to money. Maybe we're holding on to a little bit more rate than we have periodically in the past, historically, adjusted for inflation. And Jason could probably talk about that a little bit. But it's really just, it's super aggressive out there. The market, we are seeing a ton of competition. Every shipper we talk to that we're soliciting is like, you're the 50th call today, you're the 100th call this week, and it's just added competition, really weak market, aggressive pricing, and sales tactics are leading to a lot of real challenging days out there for freight brokerages.
Well, that's an interesting point you bring up on like the bankruptcy side, Dave, because I want to talk to you about this, Ben. So we saw during the COVID period a ton of investment in freight technologies and trucking generally. And then we saw this kind of the slowdown. What is happening in the capital markets? Are people still throwing money into transportation, or is this something we're sitting back and watching to see who goes bankrupt? Maybe I can swoop in and grab somebody for a good price.
Yeah, great question. So let me break that into a couple of parts. First of all, there's the logistics investment, then there's the supply chain technology investment. Okay, so there was a tremendous level of M&A activity and investment activity on both sides, but lots of acquisitions in the logistics arena, 2020, 2021, and 2022. You saw truck brokerage companies that might have been doing 10 million of EBITDA, might get valued at 15 times EBITDA during those bull years. And of course, that was not only high on a multiple basis, but it was also high on an EBITDA basis because the EBITDA was inflated because we saw freight rates basically doubling during COVID, right? So if your rates have doubled and you're in the brokerage business, and that means that it pretty much all falls to the bottom line, your margins go up. Dave can attest to this. Or you can look at the public data. Look at C.H. Robinson, look at RXO, look at before they went private, Echo. The average margin, gross revenue to net revenue in truck brokerage from 2015 to 2019, right before COVID, was around 15 to 17%. It depends on where you were. It might have been lower if you were, more kind of, mass market, maybe in specialty areas a little bit higher, but you were kind of in that 15+% range. Margins shot up to the 20s as a baseline for truck brokerage, Why? Because rates went up and you didn't have to do more work to get a higher price. So it makes sense. So you had inflated EBITDA, inflated pricing, and inflated multiples. And all that meant that if you owned a truck brokerage company and you sold in 21 or 22, congratulations, you hit the jackpot. But for everybody else, not only are things much lower on all of those dimensions, but you also have a psychological gap. Okay, because you think about it, whether those were fair values or not, if you thought, hey, I used to be a $5 million EBITDA company before COVID, then I shot up to 10, and then I thought I was worth 15 times and 150 million. Now I'm back to whatever, 3 million of EBITDA, and the market today is more like 4 or 5 times EBITDA. Am I worth 1/10 now of what I was worth 2 years ago? And the honest answer is, well, you're probably David Shake is nodding his head. Yes, if you had sold 2 years ago, but in reality, you probably didn't get. I mean, if you didn't sell then, you didn't get that price, and maybe it was a fantasy number anyhow. Probably the better baseline to compare it with is what was I worth prior to the COVID, the great inflation, right? So we're living through the great freight recession now, but the great inflation of freight during COVID, of course, was the opposite. So that company that was at 10 during, COVID inflation and is now at 3, maybe they were at 5 in 2018, and maybe that business was worth 6 times then. And so, I think there's a whole psychological reset, and that takes time. I mean, we lived through this during the great freight recession of 2006 to 2009. It really took another 3 years before you started to see deals happen because the sellers said, "Hey, I don't want to sell in 2007, 8, 9. I remember what it was like before." And the buyers, of course, said the opposite. So it took 3 years before there was some sort of balance. And I think it's worth noting that when you think about the biggest deals that have happened in our industry, they usually start happening 2 or 3 years after one of those recessions bottoms out. I'll pick an example. Who's probably the best known acquirer in our industry over the last several decades? It'd probably be Brad Jacobs and the consolidation at XPO. Well, when did he buy Express One and rebrand it as XPO? 2011. Okay, back to my point. That was 2 years after the great freight recession of 06 to 09 ended. So I think we're still going through this psychological reset, which in the deal world is just as important as the financial reset.
Do you think, Ben, like after we saw with like Convoy, so the venture capital world, we saw this amazing business that's had this $3.8 billion valuation, an amazing company, and then runs out of investor capital. Do you see venture capitalists being a little bit skeptical of the freight technology going forward, or does it just kind of business as usual? That was an aberration. We can move forward from that.
Yeah, so I think there are 2 parts to that. I mean, first, as a matter of data, the answer is yes, overwhelmingly. If you look at freight tech investing, venture funding peaked well, this is true as a whole for venture as well as freight, but venture funding was 681 billion in 21, and it was 285 billion in 23. And then freight tech, which was about a tenth of that, dropped by an even greater percentage. Okay, so yes, logistics technology as a category is attracting a lot less capital today than it was then. And that may not necessarily be a bad thing. I mean, if you're an entrepreneur raising capital, it might feel like a bad thing. But there was a lot of tourist money that came in and went out, and maybe that's for the best. Having investors that know the industry and that add value and get involved, I think is a good thing. But there's a second part to your question, and that is, since you brought up Convoy, there were some companies that were pure software companies, and then there were other companies that were services businesses that had software in them. And one of the crazy things that happened in this market for a brief period of time was there were investors willing to value the second like it was the first, right? If you were a tech-enabled services company, objectively, should you have gotten valued on a SaaS multiple like you were?
Yeah, revenue times 10, revenue times 20. That seems reasonable.
There you go. And I'll tell you, it's funny. I remember at the BJSA supply chain conference last year, somebody asked the question, what's the difference between a digital broker and an analog broker? And Sid Brown, NFI's owner, Dave's buddy said, well, the difference is that the digital brokers don't make money. And it was funny because it was true, right? Because if you looked at it, look, I have a lot of respect for what Convoy built, a lot of respect for the technology, but I also have a lot of respect for the tech-enabled brokerage companies like NFI, like Echo, and others. And in fact, I'm sure Dave would argue, and he'd probably be right, that a lot of the technology that NFI has is better than that of many of the so-called digital brokers. Echo would say the same thing, and so would others too. So in the end, I think it was an anomaly for people to give, quote, digital brokers that were really tech-enabled services companies the kinds of revenue multiples that historically only accrued to pure software companies. That's not happening anymore, but I think that's healthy, and I think that's a reset back to reality.
Well, I like building off that, Dave. So NFI as a tech-enabled brokerage is a way to kind of look at this, as kind of been alluded to. When you see a platform like Convoy disappear, what are the shippers doing? What are your customers? How do they react to like all of the noise of these companies that come in and promise the world and then can't deliver when markets get a little tight?
They move to the next broker. That's the problem with this industry, is that people don't treat it like a commodity. And the truth of the matter is that you could hire 5 different brokers to move the same load 5 days in a row, and their price is going to come in within 5% of each other. And aside from some personalized service, they're all going to feel relatively the same. And that's the definition of a commodity. And so as a result, if you can't create a differentiation with your technology in a way that makes you hands and above better and gets that person coming back to you, then how do you make a difference? And in the end, look, I think the world of Dan Lewis, and I really feel horrible for the way that all went down, because I think it was wrong place, wrong time, wrong vicious cycle. And they did build some really good technology that is surviving with Flexport, that was bringing some value to the community. But at the same time, shippers didn't miss a beat. I didn't get any phone calls from shippers saying, "Oh my God, Convoy left us standing. We need to move this freight. What are you gonna do?" It didn't happen. And maybe somebody got that call, but I don't think very many people got that call, especially in a weak freight market, because that's not the way this market works.
One of the things, I'll let you jump in a second, Jason. One of the things I noticed when Convoy went out was shippers were going to their brokers and saying, we need to make sure you're financially solvent. Like, we need to make sure you're not going anywhere because we can't have a disruption. We had seen Yellow wind down. But I'm curious, Jason, like what did you kind of see when you saw a company like Convoy exit the business?
It is just as Dave mentioned, there was a lot of, oh my heavens, is this a disruption? It's like, this is such a small piece of that market. And again, we were in a plentiful capacity scenario. And what I was thinking of, just as Dave was talking, was the parallels to Yellow. So back in around June of 2023, I got asked by quite a few folks in the US government saying, we all know Yellow's not doing well. If they fail, how bad will it be? And you looked at the Bureau of Labor Statistics data. It's like, if we lose them, it's not going to really affect that much at this point. And I remember being one of the folks who came out, fairly early on and said, look, if Yellow fails, it's not going to be that disruptive. And a lot of people, oh, no, it's going to be. And I hate to say it, it was pretty much a blip. It was not nearly the disruption that folks thought. And it's just because it is a down market. Had any of these events happened in 2021, let's say around, August or September 2021, then it would have got a little spicy. But all of these events happened in the midst of, again, the steepest freight recession we've had since the global financial crisis.
And quite honestly, happened as a result of that steep decline.
Yep.
Right. If the market hadn't have declined, look, people don't want to talk about real numbers. Let's talk about real numbers. My revenue went down 57% in 18 months. So that is what every brokerage business was dealing with. That is rate deflation. It's a real thing. By the way, they went up by that amount too. But when you deal with that down cycle that fast and you are not in a solid fundamental financial position, it is going to cause problems. And in the end, the only way that happened realistically is in that environment.
No, and I think you raise a great point, Dave. I was going to say the disconnect that is felt between how much have freight volumes really fallen and therefore how much has trucking employment fallen versus how bad it feels. The feels is based on how much have rates come down. And Dave, just like you said, I mean, you can see the PPI for freight transportation arrangement going off a cliff in 2022. And that's what people are feeling. They're seeing the revenue go down. But it's like you said, revenue-wise, you're probably 2019, maybe adjusted for a trend line upward. That's probably where you're at today. And so we've had this almost hangover that's taken place versus what differed in 2007 through 9 was just freight volumes. We lost 20% of freight over a 2-year period. And so that's where there's kind of this disconnect between those two sort of great freight recessions.
You were going to add something, Ben.
Yeah, the interesting thing is, first of all, Dave wins the Truth in Advertising Award for sharing data. People never share data in these discussions. I don't know why. It's good to be precise about what you're experiencing. Secondly, Jason makes a great point that yes, structurally, the takedown of a truck broker was insignificant to the overall economy, but it did have other ripple effects. And I think it's worth double clicking on that. So who is the biggest loser? I mean, well, look, aside from the shareholder loss and the employee loss, it was the carriers, because there were a lot of carriers that didn't get paid. So one of the interesting things, and Matt, as the armchair attorney, you know this, there were lawsuits where some of the carriers sued customers, shippers like IKEA. They said, hey, we moved your freight and we didn't get paid. And IKEA had already paid once, and I think they ended up paying a second time, right? Because they paid Convoy once, then they paid the carriers a second time because they just didn't want to be in the lawsuit. One of the ripple effects of that is, I think we've seen something in freight brokerage, and I invite Dave to comment on this. It's kind of like the logistics version of a run on the banks, because all of a sudden, what happens? It's a psychology game. If you're a carrier and you're afraid, hey, if I work with this broker and something happens, am I going to get screwed? And so what do? Well, one is, they might go and, check the credit rating. Two is, they might decide to go file against a company's bond. But what happens then? Well, if someone files against a broker's bond, it can set a whole chain of events into effect that can ultimately take that broker down. The interesting thing is Convoy didn't fail because of its burn rate. It failed because it took on debt. And then when there was that sort of run on the bank and factoring companies cut them off, all of a sudden they were SOL. So I think it's important to note that there's this unfortunate dynamic where the financial institutions can actually be magnifying the problem. And so what do you end up doing? Look, I'm in this, among other things, as an investor, because Cambridge Capital, we have 8, soon to be 9 portfolio companies in different areas of supply chain. So we invested in a truck brokerage company, Everest. So we put some more cash on the balance sheet of the business, and it was okay. It didn't need it, but one of the main reasons why was we wanted the credit rating to go up. It's great. Credit rating is now 97, so it's fantastic. But I come back to the core point, which is that the psychology is sometimes the most important thing. And if people perceive a risk and the financial institutions restrict credit, that in turn can take down companies if it's not dealt with.
I like to build off what you guys were talking about a little bit a moment ago on Yellow, and like Yellow going bankrupt, not really impacting the general market as a whole because it wasn't moving a ton of stuff. But I would say, I'd like to get your thoughts on each of you guys. This almost felt like the nail in the coffin of the unionized motor carriers of yore. I mean, Yellow started in 1924, Roadway was 1930. I mean, there was a time in this industry where you had to move everything with a unionized Teamster trucker, with unionized mechanics and unionized dock workers, and it was all one organization. And we've seen this after deregulation, this great change. And we now see really only 2 unionized motor carriers of scale. We have ABF, owned by ArcBest, and we have TFI, who bought UPS Freight, used to be overnight. And I'm kind of curious. I'll start with you, Ben. Like, what do you think about this? Like, has that day ended? Are the unionized motor carriers of the old days, is that gone? Is that a thing we have to think is no longer happening?
Well, it should be. I mean, the reality is, like, if we go back to the beginning. Why were unions established? They were established to protect workers from abusive management practices. So like the Triangle Shirtwaist Factory, where people were in there working and there was a fire and the doors were locked because the owners wanted to squeeze out every last bit of profit. I mean, like there were terrible abuses of labor, 100 plus years ago. And I'm not going to say that everything is perfect now, but the basic rationale for unions, in my view, doesn't exist the way it did 100 years ago. And so, meanwhile, companies that are unionized, like a Yellow, for example, have a handicap versus those that are non-union because they just have less flexibility. It's not even about the wages so much as it is the flexibility in terms of decision making. So, my personal view is the unionized trucking industry has been dying a long, slow death for the last 50 years. It may be that Yellow accelerated that, and I'm sure I'll get flamed by some, angry pro-union people for saying this, but it just doesn't make sense anymore. And so, if you think about it, if you are, if you're Dave Broering and you're going to run a business, would you rather run a business where you get to make decisions in a responsible manner as the head of that business unit, or would you rather be in a situation where you have all these other non-economic constraints that prevent you? So naturally, the best talent flows to the companies where you've got the best opportunity. Similarly, if you're a customer and you say, hey, I could choose between getting my freight delivered by a point-to-point LTL forwarder that takes 2 days, or a unionized, long haul freight that gets consolidated and deconsolidated 7 times as it goes coast to coast. So I got to pay more and it takes 3 times, 4 times longer. Like who in the right mind says yes, I would prefer that. So, I think it's terrible that Yellow went bankrupt. A lot of good people, a lot of good jobs, and a lot of people that suffered from it. But I also think it's kind of the inevitable conclusion. And it's probably for the best for the industry to have more flexible companies that could be nimble and that can respond to the market conditions.
What do you think, Dave? What do you think about the legacy of that institution?
Leave it to a lawyer to ask a really, really uncomfortable topic. Look, what I would say is I think it comes back to capital markets. And when you think about unions, and Ben said it, it's all about representing the underrepresented. And I think there are still really valid places in this economy for unions and the underrepresented. But what I would come back and say is that general freight, over-the-road trucking, I'm trying to use Jason's data terms here, that world is highly competitive. And the phrase we always use internally here at NFI is that trucking is a pennies business. Well, when it's a pennies business and there are 115,000 of these carriers out there competing against each other in these tiny little pockets, it doesn't allow for the sort of labor costs that unions typically can compel a company to pay. Now, the reason they still exist in a large part or a larger part in LTL is because there's substantially less competition. It's a lot more nuanced, and there is a little bit more control from a pricing perspective. And that's why you still see some of these companies like ABF, TFI that do have unions, and I think will still continue to be unionized. What I think is interesting is if you look at the market, I haven't seen a new LTL carrier of any note or size enter the market in probably a decade. And I've heard of 3 in the last 18 months that are coming to market or are starting to enter the market now. And I think it's really interesting that that's coinciding with Yellow leaving the market, and leads me to believe that maybe over time we might see a little bit of a differentiation and maybe some progression here in what I think is the most unflinchingly painful aspect of our industry. And that's the freight classification system and the density-based weighting and all the things that go with LTL that are really complicated and nuanced that could theoretically be simpler. So long and the short of it is I think there's a place, but I just don't think it's in the broader OTR ecosystem.
What I would add to that is like there is still the legacy remains. So like FedEx Ground routing parcels today, that used to be roadway package systems. Saya used to be Preston Trucking. So that is their legacy aspects of these carriers are still out there. Conway, former kind of CF folks, also now part of XPO. And even like the most popular truck over the road right now is the Freightliner, who is first initiated by CF. So there is this legacy of this history of this industry. Jason, I'm curious, like we've just seen some of the quarterly reports. Some companies did great. Some companies didn't do great. I think of Heartland Express. I have worked with Heartland for well over a decade. Love that company. Very disciplined. OR of 104%. Like what in the world is happening right now with carriers in this time period? Oh, you're muted.
I'm going to say, when you see the couple fairly good reports, it was mostly parts of LTL. And again, the thing to keep in mind is when you think about it, a lot of the LTL carriers still had very weak quarters, and that is with Yellow gone and that all that freight being reallocated, which when you think about it, that was the third largest player 2 years ago. So that is a very scary thought that you could have freight volumes down when 10% of the freight in that sector got reallocated. On the truckload side, it was just a brutal quarter. And again, the freight is just, domestic manufacturing activity is weak right now. We're not seeing any signs of some type of substantial uptick. And I think when we look at it, the challenge has been too many of the public TL carriers have called. I mean, back in early 2023, right? It was, well, the market's going to turn in the back half of 23 when retailers restock. Then in this January as well, the market's going to turn late Q1, early Q2 when the retailers restock. And now it's going to turn in the back half of the year. It's like, we got to forget this concept of this great restocking that's taking place, because there's no such thing, never has been such thing. And if anything, we're actually starting to get some signs from parts of the wholesale sector that they're actually starting to build too many inventories again. So if anything, the more I looked at the March economic data that came out, the more down I am about any chance of a second half of 24 recovery at the moment.
So not May 15th. We're not going to see some crazy shift in the next 2 weeks. Is that a fair assessment?
Yeah, I mean, we got road check next week. That'll be a blip. Yeah, spot rates will go up. But I mean, I always keep looking at DATS, dry van spot rate versus dry van broker buy, and the spread between those. That's at 20%. That's still solidly in bear market territory. We didn't see any movement in the May spot rates in their weekly update from Tuesday. So it's just impossible to get excited now. And quite frankly, we got this month in June because in July, when the auto plants go into slow down and whatnot, I mean, once you're past July, all you're looking at is the regular sort of seasonal uptick that you may get in the fourth quarter of the year for spot rates. But at that point, it's January then. And as we all know, there ain't much freight in January and the market resets itself.
Is this the worst thing since 2008?
In terms of how prolonged it is, I actually think that the kicking around the bottom actually could be longer than 2008, because by 2007, 2008, we actually were already starting to tick up at this time. But that was after digging ourselves into a 20% hole in terms of freight volumes. Now we're down, let's call it 5%. But I could see us skating around the bottom the entirety of this year right now. There just doesn't seem to be that catalyst out there. And when you look back at normal bull market cycles, they're always driven by some type of surge in freight. And if you go back to 04, 05, 06, it's the housing boom combined with Katrina recovery. Like the shock that Katrina gave to the freight economy probably kept the freight recession at bay for another 9 months.
18 months.
To a year. Yeah, it was the incredible rebuilding effort of rebuilding New Orleans. And you can see that in all the data that was collected. But then 13, 14, kind of the next bull market. That's entirely a function of fracking and an egg commodity boom that caused farmers to go crazy in terms of buying egg equipment. The railroads were investing in rolling stock like you couldn't believe. So we had this big sort of capital investment boom. And then it all went bust and when fracking collapsed essentially in 15. Then we had 17 and 18. And that was a unique convergence of a business tax cut going into place that spurred capital investment. You had the Harvey and Maria recovery efforts, which drove a tremendous amount of freight. You had a commodity market boom that always gets kind of missed, but commodity prices went up and fracking activity in the U.S. increased 40% between 2017 and 2018. So we started fracking like crazy again. And that brings a tremendous amount of equipment demand and steel demand and all of this. You had some initial, maybe slight benefits for tariffs, so like some higher steel production in 18, then fell down. And that little ELD mandate went into effect. And so you had three demand shocks and a supply shock. Anybody think anything like that going to happen in 24 or even 25 right now?
Unless we get like 5 back-to-back hurricanes over the course of 3 months.
Yeah.
Possible.
Let me ask you this, Dave. As we just heard Jason kind of give us a rundown of this as it relates to some previous slowdowns, I have the hardest question for you. How do you motivate a team when you see an environment like this? How do you get people to all row in the same direction when it appears to be very, very bad news kind of on the horizon, or at least continue?
Oh, I actually don't think it's hard at all. I think it really relates to being good at your job and finding joy in the things that you do well. Because in the end, this industry, it's sort of like this issue where people think that when it's slow, there isn't work to be done. There's plenty of work to be done. There's plenty of freight to be moved. And for us, it's about how do we lower our total cost to serve, right? Because in the end, to Jason's point, I agree with Jason wholeheartedly. I've been telling people Q2 2025 is the next time we can expect any shot. And honestly, like we could easily slip into a recession after the presidential election, and coming into the new year, we could see Q1 be really quiet, and it could be longer than that. And I keep challenging my people with, we jokingly refer to it as flatbread. Like, what are we going to do with this flatbread market? Well, we need to figure out a way to reduce our costs so that we can make money moving freight in this market. That comes from better processes. That comes from using our technology well. It comes from implementing new technology that makes your people better at what they do, empowers them to build and maintain great relationships. There's tons of stuff to do, and that can keep morale really high because, look, in the end, if you subsisted on 20% margins, which, by the way, we never got there, Ben, so I don't know who the hell gets those rates, but we certainly didn't get those freaking rates. If you're subsisting on 20% margin, you're fat and dumb and happy. You're not building a good business. And in the end, our goal here is to build a business that succeeds in good markets and bad and can ride the tides. Maybe we don't get as high on the highs, but we definitely don't get as low on the lows. And when you do that, it makes it a lot easier to stay motivated and focused on the current thing that you're focusing on, because it's not reactionary, it's more proactive.
Do you see the margin staying around 10% going forward? I mean, that's like with C.H. Robinson's public reporting. It seems like we're getting to a number. What do you think is a reasonable thing to anticipate going forward?
I mean, I think if you go back to my comments about freight being a commodity and you look at other commodity markets that matured, I think that the thing that Jason was talking about with his, was a really nice kind of walk through the history of market cycles. What's the one thing that has really changed from 05 to now? And that's the pace and transparency of data. And so back in 05, shippers and carriers did not know what the heck was going on in the market. Brokers knew everything in the middle because they were talking to both sides, and there was a ton of leverage. That leverage disappears every single day with good data. And when you see people like Jason who are distributing tremendous data every single day, you've got people who are debunking people with other data that doesn't work very well and that doesn't represent the market and might represent other, specific avenues of focus. I'm trying to be judicious here. I believe that we are getting to a place where this is going to behave like a more traditional commodities market, where you are clearing transactions and providing a service. Look, I'll say this. I think brokers have a place in this world. Take it with a massive, salt lick grain size of salt, because I'm a broker. But in the end, there is a gap between the million shippers and the 115,000 carriers out there, and that is the intermediary markets. And there are big customers that don't want to deal with 500 carriers. They want to deal with 100, and they need 5 brokers to help them get to the access of the other carriers. And there's a service to be provided there, but it's not going to be based on leveraged arbitrage. It's going to be based on providing a service. And if people can't get comfortable with that and they want to live their life in this leveraged relationship, all they're going to end up is living and dying by the sword, because you're going to get these great highs, but then the lows are going to destroy you. And then you add in all the funny money stuff that's going on with people factoring their receivables and all the stuff they've done to build a business that's not built on real working capital and borrowed money. And as soon as those fundamentals change, the industry happens what we have now. We have 1,800 brokers that have gone bankrupt in the last 12 to 14 months. We didn't see 1,500 brokers go bankrupt in the last 20 years. And the reason that that's happened is because everybody was trying to get rich quick. And in the end, if you build for the long term, you will survive and thrive. But if you try to get rich quick, it's gonna burn you.
Well, let me ask you this, Ben. Like, if they see the erosion of margin or the push on services, what do investors want to look at right now? What are the things that people need to be thinking about?
Well, I think, look, as an investor, I'll tell you what I look for. Okay, I think number one is, am I investing in a market that has tailwinds, right? So where are their tailwinds? I'll give you an example. I mean, regardless of where we are in cycles, e-commerce growth is a huge underlying trend. And so what does that mean? It means there's growth in e-commerce fulfillment, last mile, returns, tracking, visibility. So as e-commerce grows, the logistics services to support that growth. So those are tailwinds. Healthcare is another example of tailwinds. Right. I mean, good times and bad, you need medical care, and spending on healthcare, pharma, et cetera, continues to grow. So the logistics supporting that matters. Cross-border, U.S.-Mexico, as Mexico supplants China as the biggest U.S. trade partner, and that continues to accelerate. So like, those are all obvious examples, of which there are many more. But to me, number one is you got to look for tailwinds. Number two is, does the business have some sort of a moat? Now, things that looked like moats a couple of years ago, turns out, maybe we're just, market conditions. But what are moats? Moats could be, you've got a technological advantage that nobody else has. You're focused on a customer segment that you understand better than anybody else. Maybe it's a regulated industry like chemical or something else. Maybe you've got some sort of built-in labor model. Dave made excellent points about how smart truck brokers going forward, they're not just going to make money through arbitrage. They've got to do other things. And so maybe you're better than anybody else at taking cost out and streamlining your process, and then providing other value-added services. Whatever it is, some sort of a moat is number two. Three is people. I mean, at the end of the day, logistics is a people business, and so you got to believe you're backing somebody that you think is a winner. Is that leader high integrity, smart, adaptable? To me, one of the most critical tests, and by the way, it's a hiring test as well as an investment test, is how do you handle problems, right? It's easy to be a hero when the market is skyrocketing. In 2021, everybody was a genius, right? So in logistics, but how do you handle adversity? How do you adapt? How do you roll with the punches? I mean, these are the same things that I try and mostly fail to teach my kids about, right? And so, to me, those are the critical things as an investor.
Do you see, Dave, like more of the acquisitions in the space? I'll come back to you in a second, Ben. But do you see, we just saw a big freight forwarder, Omni Logistics, and they combined with Forward Air, an LTL provider. Are we going to see more mergers, or are we going to see bigger getting bigger, or do you think there might be some fragmentation coming around?
Well, I think Ben alluded to it earlier, and the disconnect that exists in the market sort of runs in waves, right? So first you've got the company with the outsized profitability that's based on fundamentals that aren't sustainable and their expectations, and then as those come down, it becomes, oh well, I think my business is worth more than that. And then you've got the buyer who's like, well, this isn't realistic, and I'm not going to buy this. And then over time, they sort of get closer and closer together. where their expectations become more realistic. And it's been, I don't know, Ben, what's been 3 years since the expectations have been relatively well aligned on the operating side, right? Set technology aside, that runs on a different fundamental. I think we're going to see a lot more acquisitions in this space over the course of the next 18 to 24 months, mostly because I think people's realities are more aligned. And really, in the end, what it comes down to is, and I jokingly call it broken mirror syndrome, right? When the buyer and the seller get up in the morning and they look in the mirror, do they see who they really are? And if they do, can they get on that same page together and get a deal done where it creates value for both sides? And in the end, like, I'll go back to Sid's father, Bernie Brown, said something that I will live by for the rest of my life, that you've got a good deal when both sides walk away unhappy.
That's right.
Right. And so, like, that's really the market we're starting to get back to. And I think that that's going to lead to a lot more deal making in this space. Now, what that looks like, I'm not sure. And what size, I'm not 100% sure. You've got some publicly traded companies that have got some pretty decent cash sitting on the balance sheet that can go do some things. The question is, is that acquisition going to be accretive to them in this market? Because in the grand scheme of things, maybe it's you're buying logos, maybe it's you're buying technology, but in the end, what I'm looking for when I'm acquiring a business in this space is I'm looking for people, because that's the only thing that really makes a difference in the grand scheme of things. You can buy a logo, but there's no guarantee you're going to keep it if you don't have a really good person or a really good team operating that business. And so in the end, I think it's what it comes down to is, does that organization have a good team? Do they have a solid culture? Can you consume and adopt that culture in a way that brings value to your business? And will they still be there 2 years from now? Because that's where all the value comes from.
I couldn't agree with you more. Back to you, Ben. I want to get your thoughts on Omni and Forward Air. There's other deals I want to talk about, but that deal has just captured the imagination for me, and I assume tens or dozens of other people. What do you think about that deal?
Yeah, well, I'll tell you, for those that were at our conference in January, Dave was there. We actually had the then CEO of Forward Air, Tom Schmidt, on the stage with me the day the deal closed, and we did a deal talk. Which was an amazing discussion. Unfortunately, the board of Forward Air didn't feel the same way that Tom did, and here we are. But look, that was a very interesting deal for several reasons. Forward Air, when you look at its roots, Forward Air started out doing airport to airport trucking on an on-asset basis. The old line that the cheapest plane rather, is a truck. So if you knew that you were going to ship something, you were going to fly it from, I don't know, like Philadelphia to Pittsburgh, and you could put it on a truck and it would take just about the same amount of time, but be much cheaper. Forward Air figured out how to go hive off that business. And they did a great job doing one thing really well. Unfortunately, that one thing was not that huge of a market. So over time, when Scott Niswonger, the founder, retired, and subsequent people, stepped in to lead the business, and ultimately Tom Schmidt, they diversified. They moved into other adjacent areas. They went after last mile, and the Omni acquisition was only the next step in a series of steps as Forward Air continued to grow and continued to diversify. By the way, I think a lot of those moves were smart moves, but the issue with the Forward Air Omni deal was Forward Air paid a price that in hindsight they thought was too high. They added, Omni was a lot of things. Omni was a consolidation of lots of different businesses. I don't even think Forward Air knew all the different things that they were buying. And the mistake ultimately that, Tom would tell you that he made was, while he had the legal right to just go ahead and close the deal without calling for a shareholder vote, it's one of those situations where just because you could do it doesn't mean you should do it.
That's right.
And so there was a shareholder revolution and people were pissed off. And in the end, Forward Air came back and tried to, restructure the deal. And not surprisingly, the guys on the other side at Omni didn't want to. And so then they sued to try to unwind the deal. And, it ended up being one of those courtroom step settlements, right before the very end, Chancery Court in Delaware. And so a lot of interesting takeaways, but I think the biggest was Forward Air bought Omni mainly because of the LTL capabilities that Omni had, and that made great strategic sense. Not every piece of Omni fit within that, but a lot of it did, and so, look, unfortunately, Tom isn't the one that will get to implement that, and we'll see what ends up happening and what Forward Air ends up doing. But I think there's several key takeaways from that deal. One is that when you're a public company, you have pressure to keep growing, and just because you dominate a niche, at some point you reach saturation. You've got to start thinking, how do I expand beyond that niche? And there's a risk in pushing too far there. Second is, when you're the CEO of a privately owned company, right? I mean, when you're NFI, you can do whatever you want. When you're a public company and you've got these pesky shareholders that want to have a say, well, guess what? If you don't listen to them, you can have a revolt on your hands, and activist shareholders and other things that can cause that. And then look, number three is, when you are taking on debt in the context of the deal, and there wasn't a significant component of debt for this. It raises the stakes, and look, I think in the end, it remains to be seen what will happen with Forward Air, and did they stay the way they are now? Did they stay public? Do they sell off parts? There are lots
Their
of
numbers suck today.
Yeah, so that's right. So in the end, but I think it's a pretty interesting case study. The one last thing that I want to add is, maybe that's an example of a deal gone bad, but there are lots of good deals that are getting done right now, and I think we'll see a lot more of them. They fit within a few buckets, and I can elaborate on that, but let me pause there, because
we are getting close to the end of our recording, and I want to ask you guys a couple questions we've had kind of come through a little bit. And the one question I want to start off with is, all right, we talked about Yellow's failure. We talked about Convoy wrapping up. Are there any companies out there right now that we should be concerned about not being able to make it the long haul? Are there any companies out there? How long can the big publicly traded trucking companies survive on an OR of 99 or a 101? Anyone have a thought on that?
So anybody want to start a bank run on a carrier?
Yeah, that's a good point. Yeah. Everyone's doing great. The market is fantastic. Well, I guess maybe the thought I'd say is, let's look at ABF. Do we think ABF is going to get bought by TFI? Because there's talk that ABF might be up for sale. ArcBest hasn't made any big moves, but I know TFI owns at least 4% of ABF. Do you see a deal like that happening this year, Ben?
Well, I'll give you my opinion. Does it make sense? Yes. It makes sense, number one, because consolidation in trucking, which has been a long-term trend, is continuing and should continue. One. Two, there are very few people that want to buy anything that has unionization in it for reasons that we've just talked about. But ABF is one, but Transforce is one of them. And so, TFI buying ABF is possible for that reason. Number three, ABF is either really cheap or really expensive, depending on your opinion about the pension liability. So, not to geek out on the accounting, but this is actually, is super important. When you look at the ABF numbers, you could say that on an historic basis, it's historically traded at like 3 times EBITDA. That's pretty cheap, right? And sounds great, except for one thing. Those multiples typically don't take into consideration the fact that there's this massive debt in the form of a pension liability. So as a unionized carrier, ABF has this obligation to pay, the lifelong pension costs that, number one, they're large numbers today. And number two, historically, those numbers get bigger and bigger over time. Those of us who remember the Central States, pension fund, and one Jimmy Hoffa fiasco, that sort of created this. Basically, because there were bankruptcies, in the end, the people that end up having to pay the cost for those other trucking companies' bankruptcies are the ones that are still alive. So the healthy ones pay for the sick ones, and so the pension fund liabilities for those surviving companies just continue to balloon. And of course, ABF is one of those companies that's bearing the burden for that. So I'm giving you reasons why a deal could make sense. The biggest reason why it might not happen is this last point, this massive ballooning pension liability. My personal view, and I'm not advising TFI in this, and if I were, I wouldn't be able to talk about it because it would be material non-public.
This is a safe place.
But if I were advising them, I would say if you buy a company that has this kind of huge pension liability, you have to find some way to freeze the liability as a prerequisite for the deal, and that requires multiple things to happen. If you don't have that, and you're just basically writing a blank check for a ballooning pension liability, you're going to end up regretting it.
Well, there's been an ongoing story about UPS potentially selling off Coyote. There's been talk of Uber selling off Uber Freight. Do you guys see any of that potentially happening this year?
I think all of it could happen. The problem will be the psychology issue, right? I mean, if you're UPS and you paid $1.8 billion for a business, that was 2015, 100 of EBITDA, and you paid 18 times for it, what would it get today? It's not going to be 18 times EBITDA, and it's probably not 100 of EBITDA either. So I think if you can get past the psychology, any of those deals could happen.
Well, let me turn to you in this, Dave. Let's say, as we're getting close to wrapping up here, go back in your 20 years ago. What would you tell if you were a young person in the industry now? What would you want to tell them to let someone know how to handle this type of a market?
Don't get into freight brokerage. I mean, honestly, if you're in this industry, you're in this industry, and you got to deal with the ups and the downs. That's the way it goes. When you're a middleman, you don't get to pick your market. You just have to deal with it. And I would actually like to ask Jason, who has been quiet and even got up and vacated his seat for a minute, what data we need to see change in order for this market to really start to look like it's inflecting. So just, I believe in the data-driven decisions, and I believe in Jason's missives. Where does this need to go, Jason, for this worm to really turn?
It's going to sound the oddest thing. Food manufacturing needs to get back to its typical seasonal pattern. 2023 was one of the softest years of food manufacturing that we've had in a long time. There was not that seasonal spike. Food is 15% of trucking freight. And a big part of that is our exports are down 10 to 15% below where they were in 2017, 2018. So we've got to start seeing manufacturing really pick up. A big chunk of that is on the export side of things. The challenge is, as you look at Europe's economy, nobody thinks that any of the countries in Europe that are major are doing that great. Germany's industrial activity has taken a much worse beating than the US's has. And then you look at China, big trading partner for us on the export side. They're not doing well. So we've got to see manufacturing turn. We have to get there with that. Fracking will not rescue trucking like it did in 13, 14, and 17, 18 because the frackers just don't behave the way they used to. Single family housing doing better would be, it's up 10% from where it was before COVID, but existing single family sales are down 15 to 20% from where they were before COVID. So in a net freight generating basis, that's canceling itself out because when people move to an existing new house, so often buy new washers, dryers, carpet, etc. The one sector to keep watching really closely is motor vehicle production and motor vehicle sales. That's been the one sector of the economy that's been doing phenomenally well. If we see that start to turn down, that will be a red flag that this current freight recession will get even worse. And then I keep preaching it, but paper manufacturing. Paper took a huge drop come the second quarter of 2022. Do we start seeing paper production pick up? If the answer would be yes, then I would be quite encouraged that we will actually start coming out of the doldrums. But paper is the fourth largest ton mile generating manufacturing sector in the United States for hire trucking. And it's down.
And the cheapest freight on the planet.
Yeah, that too. But it's because there's so much of it that comes, right?
And it's just not worth much.
Yeah. And so we have to see manufacturing tick up. And, the Fed does a great job with the industrial production data, but you really have to start dialing things in. The other thing I'll say is a lot of people bring up to me, they'll say, but all the infrastructure spending. right now, production of non-metallic mineral products, which includes, cement and concrete, on a seasonally adjusted basis, is heading down, not up. And it's down 10% from last year almost. So the infrastructure spending is equally not going to save freight volumes.
And you have to back out all the chips related spending that's going on in this country from the R&D and infrastructure investment as well, because super high dollars that produces zero freight. Zero freight.
Yep. And that's the reality.
If we had more capacity exit the market, Jason, we saw Arnold Transportation, kind of a regional truckload provider, out of business. Is that a way to get out of this? Is there enough capacity that could be pulled out that would push a recovery?
We've never exited a freight recession because too much capacity leaves. Business owners are inherently optimistic, so people are going to stick around until the very bitter end. It's often very common, even for, if you look in 2009, the bottom of that freight demand piece was around the first to second quarter of that year, and then we started clawing out. But trucking payroll didn't reach a bottom till March of 2010. So there was like a 9-month lag between the two, where operators who thought they could stay in business still just ultimately ended up closing up shop. So if we started to see a, let's say, 2% or above year-over-year increase in demand, then we'll get out of this, let's say, in 2025, because you will start to see more capacity exit if folks thought they could stay in business, but they won't. And so right now, I'm just not encouraged by any of the data I'm seeing. We've had 3-year freight recessions before. 1979 through like the start of 1983 was basically almost a 4-year freight recession in trucking. So we've seen longer.
That on that encouraging note, I think we'll go ahead and wrap up for today. I want to thank Ben and Dave and Jason for making time to hop on and talk about some of the interesting things happening in the industry. Are there any final thoughts anyone would like to leave before we wrap up for today?
Well, I want to end with a note of optimism, because there's an awful lot of gloom and doom here, especially hearing what Jason said about how if we need to expect a recovery in food, I guess you could say that Ozempic is hampering the freight recovery. But on a positive note, look, I think there's still innovation. I would say that, pick an example, NFI was formed in 1932, right, during the jaws of the Great Depression. So lots of great companies do great things during difficult times. And I think these are, this is sort of the time that can forge greatness. Second thing that I would say is there is still lots of M&A activity. We're seeing it, at Cambridge Capital on our private equity side. We're closing on an investment tomorrow. And BGSA, our investment bank, we're working on 3 different deals. So there is activity. And then lastly, look at the public markets, capital markets. Today, there was an IPO of a company in our sector. It's worth noting that that doesn't happen every day. This is Proficient Auto Transport, which was a roll-up of 5 auto hauling companies. So, things are still happening. So, yeah, things are difficult, and yeah, the market conditions are hard, and it's easy to get depressed by all that. But now's still a great time for innovation.
Well, I think we can leave it up with that positive note. Again, I want to thank all of my guests for joining on today. For everyone who's watching at home, thank you for joining us. Jason, you're out. Dave, you're out. Ben, you're gone. Everybody, thank you again for tuning in. It's always a pleasure to sit down with the best and the brightest in this industry to help bring information and knowledge to you for free, because that's what we do. As always, thank you for tuning in, and have a great rest of your day.